Investment risks, navigating the uncertainty of the market. Investment activities always come with risks, much like the two sides of a coin. Whenever you consider a particular investment, sooner or later, you must think about the risks associated with it. Investors design their own portfolios, hoping that their personal assessments of a company's quality will be recognized by the market in the future. However, no one possesses the ability to predict the future with precision. The future is entirely uncertain, but investment is intrinsically linked to it, like a shadow to its form. Learning to face the uncertainty of the future is essentially learning how to control investment risks. To become a smart investor, risk management is an essential skill. The illusion of skill in an uptrend. During an uptrend, any lucky fool can appear to be a genius. It's incredibly difficult to distinguish skill from innate foolishness when the market is soaring on the back of an exuberant bull. When the market is rising, every investment seems profitable. The easiest way to increase profits under the strong influence of greed is to take on more risks. Increasing margin leverage becomes the default style for most novice investors borrowing money you might not be able to repay in the future to bet everything on the market. After all, it's very hard to stay idle while others are getting rich quickly with full margin strategies. Only when the tide goes out do you discover who has been swimming naked. Warren Buffett often jokes about the market's frenzied excitement. Unfortunately, most investors, fueled by continuous greed during uptrends, end up learning the painful lesson that market crash plus full margin equals account blow-up. Risk is always an essential part of the market. Every decision an investor makes carries inherent risks. You can never achieve long-term success in the market without knowing how to manage investment risks. The market is ruthless, don't be the ones left bare. When the tide goes out, the academic illusion. If you've ever studied finance or economics, risk is defined by the beta index, a fancy term for the volatility level of a particular stock compared to the overall market. Risk is measured by the past price fluctuations of that stock relative to the market. By this logic, if a stock's price plummets after a downturn, it is considered riskier if its price remains around the previous level. Buying a stock that has dropped sharply after a significant decline carries more risk for the investor compared to buying the same stock at its previous price level. Yes, you read that right. The academic logic behind the beta index suggests that buying cheap is riskier than buying expensive. This is the nonsense that business schools and finance programs teach their students every year. Entire theories about portfolio construction and optimal capital allocation methods are built on the foundation of beta, the index of a stock's past price volatility. Economics and finance students spend considerable amounts of money learning these irrelevant theories, completely detached from reality, while professors continue to preach them absolute truths. Countless famous investors around the world have criticized the academic concept of beta as entirely unrealistic. For them, the real risk investors face has never been the price volatility of stocks. Therefore, most of what professors teach at universities lacks practical applicability in investing. It's like teaching a fish how to swim. No matter how fast the fish swims, the fish still needs to learn. The origin of the academic illusion. To understand why this delusion has persisted for so long, we should look back to the origins of modern economics. Adam Smith. In his famous book The Wealth of Nations Adam Smith's profound thoughts laid a solid foundation upon which his successors gradually built the colossal house of economics we know today. With his widespread influence, many mistakenly consider him a pure economist. However, Adam Smith never truly saw himself as a pure economist. He always took pride in introducing himself as a philosopher. If you've read The Wealth of Nations you will never find a single mathematical formula or economic chart written by Adam Smith, a reality completely contrary to today's basic economics textbooks. In what is considered the cornerstone of economics, all you encounter are profound philosophical arguments about how the social economy operates. For him, economics was a socio-political discipline, a small branch intersecting sociology and political science. Adam Smith's economics viewed the interactions between individuals as essential to the functioning of a market economy. The pursuit of scientific economics, until his disciples emerged with ideas that forever changed the field of economics, the natural development of mathematics, and the remarkable success of classical physics, especially the towering status of Isaac Newton after publishing Philosophiae Naturalis Principia Mathematica*, which introduced Newton's 3 famous laws, caused a significant impact on the intellectual community of that time. It's no exaggeration to say that during the early days of economics as a discipline, physics had become the king of the sciences, with Newton sitting on a throne of immense power. The generations following Adam Smith dreamed of a day when economics would be recognized as a mainstream scientific discipline, hoping that one day an economist would take over the throne Newton left behind. It was a dreamy illusion, but a beautiful one. And so began the scientific race to formalize the field of economics. The great success of physics stemmed from the absolute predictive accuracy of theoretical models describing natural laws governing the universe. This extraordinary success could not have been achieved without the robust support of mathematics. The mathematical precision and the predictive capabilities of theoretical models became the ultimate weapon that made Newtonian classical physics the king of the sciences. With its high status and prestige, it's no surprise that physics created an aura that could blind those aspiring for similar status. Aspiring to transform economics into a mainstream scientific discipline, Adam Smith's disciples felt compelled to mathematize their field. They yearned for the absolute precision of mathematics, theoretical models resembling scientific rigor, and the reputation that a scientific professor could attain. In their blind pursuit, they forgot one basic thing. Economics is a socio-political discipline because it focuses on solving problems related to human behavior in the economic market. And humans are always emotional beings. Modern economics, mathematical complexities detached from reality. Today's basic economics and finance textbooks are filled with advanced mathematical equations, theoretical models with unrealistic assumptions, probability graphs, and more. All these mathematical tools have been added over time with the aim of turning economics into a mainstream scientific discipline. Economists after Adam Smith have always aspired for their field to hold the same status as modern physics or biology mainstream scientific disciplines. However, no matter how hard they try, economics will never be a true science. The predictive power of economic models will never be reliable simply because humans will always behave emotionally. The beta index itself is just one of the various attempts by economists to model the highly emotional interactions between people. Volatility is defined as risk in the field of finance because it can be measured accurately and thus used in calculations and modern financial theories. A theoretical model doesn't need to be practically applicable as long as it meets the strict criteria of science. It's no surprise that the practical application of theory has had to give way to mathematical elegance and scientific prestige. No famous investor in the world acknowledges the validity of the beta index in determining investment risk. This illusion has persisted for so long in academia because they are trying to model something that cannot be scientifically modeled: the behavior of humans. As the renowned physicist Richard Feynman once remarked, imagine how difficult physics would be if electrons had feelings. If one day electrons suddenly had emotions for no reason, physics would no longer be a science, it would become sociology. Rethinking risk. Beyond market volatility, in rational risk thinking, what we want to understand are those situations that keep investors up at night, unfortunate events that might occur and cause investors to lose sleep. Most investors are not worried about market volatility. What they truly fear is the inability to recover their capital. This is the risk that investors are concerned about. How should we understand risk? The inability to recover capital is entirely different from market volatility. A significant market drop won't be a big problem for investors if they trust their initial analysis and hold on until the market recovers. In a sharp decline, the possibility of loss can occur for two main reasons. The investor cannot stay calm during the market adjustment and decides to sell off their portfolio to cut losses. The investment cannot recover due to the fundamental factors of the company. Of course, defining risk as the inability to recover capital has its own drawbacks. It cannot be measured as accurately as market volatility, and if it cannot be measured scientifically, it's useless for the theoretical models presented in the field of finance. However, Warren Buffett once commented, "Better to be approximately right than precisely wrong." Some things in the world simply cannot be scientifically modeled, and we must learn to accept this truth when facing risk. The accuracy that mathematics provides is meaningless if the models are built on an unrealistic foundation from the start. You can build a magnificent castle, but if its foundation is not solid, your construction is nothing more than a sandcastle. Sooner or later, it will collapse. A practical example of risk: imagine you invest $100 today, and a year later you have $200. Does this investment carry a lot of risk? Amateur investors might say no because, for them, profitable investments are never wrong. Economics professors, on the other hand, might say yes because the only way to achieve a 100% return in 1 year is to make a highly risky investment decision. However, a smart investor won't rush to answer. To them, this deal could either be a safe investment with the promise of excellent returns after financial bubbles burst, or a foolish, risky investment that happens to be lucky, betting on companies continuously hitting new highs and being lucky enough not to face a downturn. The important thing investors need to remember is that even if an investment was profitable and closed with a gain, there's no way to truly know it was a smart decision because risk is always lurking throughout the entire process. A profitable investment does not mean it was a wise decision, and vice versa. It all depends on the question: how much risk did the investor accept to achieve that level of profit? Every decision carries risk. In investing, every decision carries inherent risks. As the author explained, investment risk should be understood as the possibility of not being able to recover your capital. Therefore, any investment decision, no matter how strong the supporting arguments are, must face the risk of loss. The difference between professional investors and amateurs is that professional investors always recognize this risk and know how to minimize it to the fullest, while amateurs always have the mindset, as long as the investment is profitable, I'm right. An important concept the author wants to emphasize here is that the outcome of an investment is not an accurate measure of investment skill. A profitable investment can still be a foolish decision, and a losing investment can still be a correct decision, all depending on the correlation between potential returns and the corresponding level of risk involved in each investment decision. The role of luck in investing. In investing, luck plays a decisive role in the final outcome, but is never the most important factor. You might make the right decision, but luck might not smile on you, resulting in an investment that doesn't meet your expectations. For someone inexperienced, that decision might seem foolish because it didn't yield profits, at least in the short term. Similarly, any lucky fool who catches the right wave in the market looks like Warren Buffett to the uninformed. Whatever he says sounds like the truth, at least to those who lack understanding. Avoiding the pitfalls of greed and over-leverage. Accepting additional risk to increase profits has never been a wise investment action. Any fool can do it. All you need to do is go full margin and pray for the best. Investment skill requires much more than that. Nassim Taleb, in his book Fooled by Randomness described these lucky fools in the market as follows. When the market is going up, the best results often come from those who dare to take the most risks. Are they truly intelligent for having predicted the uptrend and decided to increase leverage to maximize profits? Or are they simply reckless speculators like gamblers who were lucky to catch a booming market? The challenge of identifying true skill. In the short term, especially when the market is rising, it is very difficult to distinguish between skilled investors and lucky fools because everyone is enjoying profitable investments. Most people are busy savoring the beautiful moments and forget a basic principle: nothing lasts forever. Every party must end, every market wave must come to a conclusion, And as Warren Buffett often warns, only when the tide goes out do you discover who has been swimming naked. Understanding what causes capital loss. If risk is the possibility of not being able to recover capital, what factors in the market cause this possibility to arise? A common factor always associated with risk is price level. A market trading at high prices always comes with high risk and vice versa. The more frenzied trading and chasing of stocks at high market prices, the greater the chance of not being able to recover capital. As explained earlier, market volatility isn't a big issue. The investor can hold on until the market recovers, provided they have thoroughly researched the company's potential and their purchase price is reasonable compared to its intrinsic value. There are two main reasons why capital loss can occur during market volatility. 1. The investor decides to sell their portfolio due to an inability to maintain composure, thus missing out on the market's recovery momentum. 2. The market recovers, but your portfolio doesn't because of fundamental factors. The investor simply bought at prices too high relative to the company's intrinsic value, a move we still often call buying at the peak. High prices and increased risk. Therefore, we can conclude that high prices are one of the most critical factors constituting risk in the market. The higher the market price at which investors participate, the greater the possibility of loss. The more excited the market is, the more dangerous it becomes for the investor's capital, and vice versa. Countless times, I've witnessed and experienced young investors enthusiastically entering the market during the final wave and watching their accounts evaporate quickly. The previous excitement swiftly turns into extreme fear, accompanied by baseless complaints like, "Stocks are no different from gambling." The market reflects the participants' intentions. Absolutely, it will be like a legal casino if you act like a gambler, and like a great place to build wealth if you act like a smart investor. Participating in the market without basic knowledge and not knowing what you're doing is akin to gambling. The timeless wisdom of Alexander Pope. Alexander Pope once mused, "Fools rush in where angels fear to tread." Although the stock market wasn't invented in Alexander Pope's time, his insightful view on the greedy nature of fools and the cautious instincts of angels will always remain relevant. Entering the market during the final wave driven by FOMO, fear of missing out, will always be a timeless reason why investors lose money. It's incredibly hard to control yourself when everyone around you is getting rich quickly. However, countless fortunes have been lost simply because of the desire to get rich quickly. Practically speaking, the more emotional your investment decisions, the greater the risk of not being able to recover your capital. Successful long-term investing leaves no room for emotions. The misconception of past performance. Most investors participating in the market expect the future to mirror the past, thereby underestimating the market's ability to change behavior unexpectedly. If the market is soaring, they expect this to continue indefinitely. If the market is plummeting, they believe no price drop is too low for them to feel comfortable investing again. Risk management seems meaningless when you have continuously profited from a series of bold and reckless investment decisions in the past. However, risk management is like insurance for your home burning down. It might seem like a foolish decision to pay for insurance when everything is fine and you're sitting comfortably in your living room watching TV with your family. Why pay for home insurance when everything is going smoothly? The answer is that only when you're standing in front of a burning house will you truly appreciate the value of the insurance you've been paying for all year. Insurance only clearly demonstrates its value when bad things happen, and the worst things always happen in the market regularly. Risk management, the key to long-term success. When commenting on the factors of long-term success in the market, famous investor Howard Marks concluded, "The most important thing is to remember that you don't have to make your best investment decision every day. The main job of an investor is to accept risk intelligently in the quest for profit. Doing this well is what separates the best from the rest of the investment community." The concept of high risk, high return is popular among investors. At first glance, it sounds like a truth, but the best investors never actually pursue it. What they truly seek is low risk, high return. Even in the highly risky field of venture capital, the guiding principle is never high risk, high return, but rather high risk, moonshot returns. Avoiding the trap of leverage, accepting additional risk to increase profits is too easy. Any investor can do it by increasing leverage and hoping for divine intervention. But as previously emphasized, terrible things happen in the market regularly. Margin leverage is a double-edged sword. It merely amplifies the results you're achieving. If you're profiting, it amplifies those results. If you're losing, it increases the losses correspondingly. Simply put, achieving high returns with high corresponding risks does not demonstrate your investment skills. A smart investor only accepts risks wisely in their pursuit of profit. For a given level of risk, they always require the potential return to meet their stringent criteria before making an investment decision. If this criterion isn't met, they simply refuse to participate. Surviving the ruthless market, smart investors understand that the market is a very ruthless place. Sooner or later, the most catastrophic events will occur. To survive long-term in a harsh market, risk management is a must. However, risk management is one of the most overlooked skills in investing, especially during uptrends. The reason is that as long as the market is performing well, the possibility of not recovering capital won't materialize. Losses losing the ability to recover capital only occur when risk is actualized through negative market movements. One crucial thing investors need to remember is that a profitable portfolio in the past doesn't mean there was no risk throughout that period. Just because the market has performed well in the past doesn't mean that risk management is meaningless. It simply means there was no slippery ground at that time. However, that doesn't mean it will never be necessary in the future. Just like a single house fire is enough to make you truly appreciate the value of your annual insurance premiums, investing is similar. You only need one major market downturn to truly understand the importance of risk management throughout the entire investment process. Anyone who neglects this has already been mercilessly eliminated by the market. The market is ruthless. The essential skill of risk management. Although risk management plays an extremely important role in investing, it remains an underemphasized skill. The reason is that throughout the market's existence, good times always outweigh the dark times. When a prolonged period of prosperity continues, most people forget the horrific moments they once experienced in the market and believe it will never return. During uptrends, it's very difficult for investors to control themselves and refuse to increase leverage or chase stocks to maximize investment profits. The fear of missing out FOMO is too strong to resist. Once again, investing and risk are always two sides of the same coin. You cannot completely avoid risk once you decide to participate in investing. Risk is always an essential part of the game. However, you can always outperform others by only participating when the potential return relative to the corresponding risk meets the stringent criteria you've set. Profitable investing during good market times is incredibly simple. Anyone can close their eyes and shoot arrows, but still hit the bullseye. Practically speaking, profits don't tell us much about individual investment skills. During uptrends, only seasoned investors can look at a profitable portfolio and recognize whether it contains significant risks. Always remember that just because your portfolio hasn't exploded like a nuclear bomb in the past doesn't mean you've made the right decisions. Risks might have always been lurking in the investor's portfolio, waiting to be realized as losses through negative market movements. Enduring market downturns with risk control. The market will always go through horrifying collapses. Beautiful periods cannot last forever. It is during these darkest market phases that risk management truly shines. Therefore, the path to long-term investment success cannot be achieved without a rigorous risk management process. Mastery of risk management is the essential ingredient that makes a legendary investor. Once again, borrowing Howard Marks' wise words to conclude, the most important thing is to remember that you don't have to make your best investment decision every day. The job of an investor is to accept risk intelligently in the quest for profit. Doing this well is what separates the best from the rest of the investment community.